For hundreds of years, finance has depended on intermediaries, banks, brokerages, payment companies, central institutions that move money, hold assets, approve loans, and process transactions. But what if financial services could operate without those intermediaries? That idea is called DeFi, short for decentralized finance. DeFi is one of the most important experiments happening in modern finance, because instead of relying on banks, it uses blockchain networks and smart contracts. Now, let's simplify that idea. Imagine walking into a bank to get a loan. Normally, the bank reviews your identity, checks your credit, approves the loan, and manages the process. In DeFi, much of that process is automated through code. No banker, no office, no central institution, just software running on a blockchain. Most DeFi applications are built on Ethereum, because Ethereum allows developers to create smart contracts. A smart contract is essentially programmable financial logic. If certain conditions are met, transactions happen automatically. This is what allows decentralized financial systems to function. Now let's examine the major parts of DeFi. First, decentralized exchanges. Traditional exchanges usually act as intermediaries between buyers and sellers. But decentralized exchanges, often called DEXs, allow users to trade directly from their crypto wallets. Platforms like Uniswap helped popularize this model. Instead of matching buyers and sellers through a central company, liquidity pools are used. Users provide assets into pools, and traders swap tokens directly through smart contracts. Now consider lending. In traditional finance, banks lend your deposited money to borrowers. In DeFi, lending protocols automate this process. Users deposit crypto assets into lending pools. Other users borrow from those pools by providing collateral. Interest rates are often determined algorithmically based on supply and demand. Platforms like Aave and Compound became major examples of this system. Now let's discuss yield farming. This became one of the fastest growing trends during the DeFi boom. Users moved assets between protocols seeking higher returns. Some yields became extremely high, but high yield usually means high risk. And that became one of the biggest lessons in DeFi. Now, let's examine the advantages of decentralized finance. First, accessibility. Anyone with internet access and a crypto wallet can participate. There are no traditional banking hours, no geographic restrictions, and in many cases, no permission required. Second, transparency. Most DeFi protocols operate publicly on blockchains. Transactions can be viewed openly. That is very different from traditional banking systems. Third, programmability. Financial systems can be built much faster using software and open source infrastructure. But now we need to discuss the risks, because DeFi is also extremely dangerous. First, smart contract risk. If there is a bug in the code, funds can be stolen or permanently lost. And unlike banks, there is usually no customer support, no insurance, no bailout. Second, volatility. Most DeFi systems use crypto collateral. If crypto prices collapse, liquidations can happen rapidly. Third, liquidity risk. Some protocols look stable during normal conditions, but during panic, liquidity can disappear quickly. Now consider what happened during several major crypto collapses. Many DeFi protocols experienced severe stress during periods of market panic. This revealed an important reality. Even decentralized systems are still vulnerable to fear and leverage. Now let's step back and ask a bigger question. Is DeFi trying to replace banks completely? Probably not. At least not yet. But it is trying to rebuild many financial services using software instead of centralized institutions. And that idea is incredibly powerful. Because throughout history, finance has depended heavily on trust in intermediaries. DeFi asks a different question. What if financial trust could be replaced by transparent code? That does not mean DeFi will completely replace traditional finance, but it does mean the financial system is beginning to evolve. In many ways, DeFi is still experimental. It is volatile, risky, and still developing. But it may also represent the early foundation of a new type of global financial infrastructure, one built not around buildings and paperwork, but around networks, software, and programmable money.